Welcome to another episode of the Evolution Podcast. Today I have a special guest. Okay, this is someone who is very accomplished in the financial industry. The financial industry, the financial space. We're going to talk stocks, we're going to talk index funds, and we're going to talk about the banking crisis. Okay. And hopefully, he's got some tips and some tricks for how you can make some money in the market. Shawn, if you want to go ahead and introduce yourself.
Hey, yeah, thanks for having me on. It's a real pleasure and excited to be here. I work for the Investors Podcast Network, which is the world's largest stock investing podcast. I'm not actually on the podcast side, though I've been on a few. I actually work on our daily newsletter, and so 7 days a week we send out a newsletter. It's about a 5-minute read, and we try to cover the three biggest stories in financial markets. And we have about 30,000 readers who tune in every day just to get our updates and kind of assessment of what's going on. And my goal is to really help people improve their financial literacy. And we don't write for an audience of professional investors. We try to help regular people understand what's going on and cut through the
Got you.
jargon.
So now, what was on last week's, newsletter? Was there anything about SVB, Chase Bank, or anything like that?
Yeah, I mean, we've been keeping close tabs on the banking crisis, and that's been a huge story in markets, and things have cooled down a little bit, but really the story ultimately comes back to in many ways what the Federal Reserve is doing and their decisions on interest rates. So one of the biggest stories now is that the Fed decided to pause hiking rates, and so I think they did 10 straight rate hikes, and just this incredible cycle, and they've been able to raise rates much higher and much faster than many people thought possible, including me. And so now it looks like they're kind of taking a pause, and in many ways that kind of gives the financial system a chance to almost take a deep breath and absorb the impact of a lot of the rate hikes that have already gone through. So it sort of feels like we're a bit in wait and see mode, and specifically what they're waiting to see is how inflation and data continues to come in. And that's really determined by the strength of the economy. So in some sense, they're trying to weaken the economy, so that in the hope that brings down inflation. So that's one of the biggest stories in markets right now. And
Now, I'm just very curious as far as interest rates, and now can you touch upon how interest rates affect unemployment?
yeah, well, it's a contentious question, really. And so interest rate, of course, are determined by um, the Fed. Well, okay, let's think of it this way: the Federal Reserve influences overnight borrowing rates, and so they have a lot of influence on interest rates. A couple months or a year out. But as you go farther out on what's called the yield curve, 20 years, 30 years, that's really more driven by the market's expectations for economic growth and inflation. So it's this kind of interesting balance of where the Fed can do a lot of influence, have a lot of influence in the short term, but ultimately there's this kind of sort of steady state of economic growth that they're trying to balance around, it's sort of up to your opinion. It's a matter of debate, but I'm sort of the belief that the steady state economic growth is really what ultimately determines long term interest rates, and so that gets into the question of unemployment. And so to put it maybe simply, of how I would think of it is, um, as interest rates rise, that makes borrowing costs increase. And so, a lot of companies that are maybe profitable on the margins, when all of a sudden, they're rolling over their loans to maybe meet payroll needs, stuff like that. If their interest costs double, obviously that's going to hurt their bottom line. Companies all of a sudden, due to those higher interest costs, are maybe no longer profitable. Then they have to cut staff. So it's sort of that line of thinking of, as interest rates, especially on the short end, as those increases ripple through the economy, you see a lot of companies on the margin decide, maybe we're not going to hire as many folks. Maybe we're actually going to start to let some people go. We saw that it was a huge thing in the tech industry for the last 6 months. There's been all these stories about massive headlines. And I mean, really one of the most interesting things in my comment earlier about, the Fed is in this wait and see mode, and they're trying to observe, what how the data is going to keep coming in of whether they want to keep hiking rates or not. And really, I guess my point is the labor market's been a lot stronger than many expected. If you told probably your average financial markets analyst this time last year that the Fed was going to hike rates as quickly and as much as they had, they probably would have told you that the unemployment rate would be 2 or 3 times higher than it is. And that's really one of the great questions in markets right now is why has the unemployment rate not risen faster than it has? In fact, we're still pretty close to all-time lows. So it's really challenging conventional economic thinking and dogma of this kind of logical point that I made of, well, as interest costs rise, obviously that weighs on companies, hurts their bottom line, and then, maybe marginally pushes them to, cut back their staff or hire fewer people. And the reality is, we just haven't seen that at a scale yet. That's really, maybe changed the Fed's calculus of how to address inflation. And so we can talk a little bit more too about the relationship between unemployment and inflation. But that's also another big question in markets too of why historical relationships between unemployment and inflation maybe haven't manifested as people expected. So I'll pause there before I ramble
No,
too
no, no, no,
much.
no, no, no. I like the fact, I like the rambling because I want to touch up on this. So, in the sense as to, would you say that the Feds, because obviously they're trying to control inflation, right? Raising interest rates, reduces spending. Now, would you say that they stopped, that rate hike to kind of tone down the unemployment numbers, right? Because what's stopping Jerome Powell from going, hey, man, you know what? I'm going to just keep raising the rates to, extraordinary levels. And, that's going to just hurt the consumer side of things, right? What's your opinion on that?
Yeah, I mean that's kind of what we saw in the '80s with Paul Volcker. Inflation, many people today might not have been alive to remember this, but we had double-digit rates of inflation in the U.S. And so the Fed chairman Paul Volcker back then, raised rates to 15, 16% to crush inflation. And so the big question really has been whether Powell who's the current Fed chair, is going to be as aggressive. And we haven't seen inflation rates quite that high yet. So there's probably not as much of a need to be as aggressive. But really what the Fed's been talking a lot about is this, so-called soft landing, which is really the hope that they can, because of course the Fed does not want to force a recession if they don't have to, but they have this dual mandate of trying to maximize for employment and also basically minimize inflation at their 2% target. And so it's a difficult balance to strike, but inflation surged so far above their normal target that they saw that is essentially a bigger threat to the long-term health of the economy. And so they're trying to do this, quote unquote, soft landing where they raise interest rates to cool inflation, which we've actually seen considerably without pushing the economy into a recession. And it's a difficult thing because there's not a clear line of how high you can hike interest rates before you do sort of irreversible damage. And so, kind of the conventional way of thinking about interest rate hikes is that they work on a, quote, long and variable lag, which means that, or a long and variable lag. And so, an interest rate hike you do today might not start to really show up in the economy 12 to 18 months later, because, back to what we were discussing before, if you raise interest rates, companies don't immediately feel that, it's maybe 6 months later that they need to go for a loan the next time. And then when they go for a loan and they realize rates are twice as high, and then, the next quarter, they see that their profits have been hit by these higher borrowing costs. And then, flash forward another 2 months, and then they're doing staff layoffs. So you can imagine that, that's why there's this longer lag. If you do a rate hike today, and you don't really start to see the real economic impact until 12 or 18 months later. So I think in my view, that's sort of the basis a little bit of why you would decide to pause right now. If you've had this really aggressive hiking cycle. And then, like I said, most people wouldn't have expected the Fed have been able to do as many hikes as they've done. And so, now they're kind of in wait and see mode of, we've done this quick hiking cycle, and how is that going to ripple through markets? And it's still very much an unknown. They believe they can do the soft landing, but again, it's not clear. I mean, some people will tell you they've already hiked too much and they've set the economy on a trajectory for a recession. Other people will tell you they need to hike further, otherwise inflation is essentially gonna reemerge. So I don't exactly know where I fall. I feel like my opinion goes back and forth on that every day. And really, just like the Fed, we're all trying to be data dependent, as they like to say, and just not stick to economic dogma, but really see what's happening in the economy and keep sort of flexible opinions on it all.
Okay. Now, in your honest opinion, do you think that we're headed for a recession?
So this is an interesting thing that I've both been humbled on, I would say, of, if you, but also I think I still kind of cling to my original opinion. So let me clarify. Around last year, a lot of people really started calling for a recession, and I was one of those people anticipating it. And so, obviously, if you predict a recession forever, uh, eventually one's going to happen, and you can claim to have been right, but you really have to be specific about when it's going to happen. And so, I thought, by this spring we would have seen signs of recession. And honestly, there's been some evidence of slowdown, but really the economy has been much stronger than most people anticipated. But that doesn't mean that we're necessarily all in the clear. And something we wrote about in the newsletter this week, it's called a yield curve inversion. And so it's sort of a very technical financial term, and it's sort of jargon we would normally try to avoid. But just to define it for people, as we were talking about, the Fed determines interest rates on the short end of the curve. So they set overnight borrowing rates. And normally what you would expect is sort of this time premium. If you're going to borrow money for 3 months, that would be a lower interest expense than if you're going to borrow money for 30 years. If you're asking somebody to lend you money for 3 decades, they're going to expect a higher compensation in the form of interest rate than somebody, you might lend money to for a couple months. But what we've seen with this in yield curve inversion is that short-term interest rates are actually far above what it would cost to borrow money 10, 20, or 30 years out. And so sort of what that means is historically that's been actually a perfect indicator of impending recession. And so the timelines of when a recession is going to come, that's the little bit trickier part to anticipate. But actually March 2022 is when the yield curve first inverted. And that's when 3-month borrowing rates exceeded 10-year borrowing rates. And so the last 5 times that's happened historically, that's resulted in a recession within the next 18 months. So we're still in that 18-month window. And, like I said, I've been surprised at the resiliency of the economy generally. But at the same time, I wouldn't want to necessarily bet against this indicator that's historically been very accurate. And there's sort of a logic to it. And the logic would be, when short-term borrowing rates jump up really high, but longer term rates stay low, which creates this inversion. Essentially what that is financial markets predicting that even though the Fed says they're going to keep hiking rates, actually in the next year or so, they're going to have to cut rates dramatically in response to a recession. So in many ways, it's almost like the market calling the Federal Reserve's bluff in many ways. So yeah, I don't know. I like I said, I'm humbled by how strong the economy's been. But we're still in that window of the yield curve has kind of predicted a recession, and it could easily come in the next 6 months.
So when is that forecasted time of the 18 months supposed to expire?
Yeah. So, I mean, if we look at it, that, March 2022 plus 18 months would be November of this year. So, around this fall, we would probably expect at the latest to see some strong indications of a recession. And honestly, if the economy is still chugging along at that point, we would really have to revisit some of that conventional thinking of, how reliable is this indicator of essentially financial markets, holding one opinion, but that doesn't necessarily match the real economic reality. And, it gets tricky because you look at it with the Fed and they're trying to make economic predictions. And that's what, they're using as the basis for their decisions to hike rates. But of course, that's a really centralized entity. And so, they have their teams of PhD economists, et cetera, et cetera. But ultimately it's, a few dozen or a few hundred people trying to sort through economic data for a $20 trillion plus economy and make sense of it all. Whereas, the quote unquote market is a more decentralized machine, taking all these inputs and outputs of pricing data and opinions from, tons of investors all around the world. And so it's more of a reflection of how, tens of thousands of investors are, what their actual outlook is. And, everybody's seeing different things of, what's happening in their little corner of the world. And then you get this amalgamation of all that. And then that's sort of the market view. So it's a very interesting juxtaposition of sort of almost a decentralized prediction for what's happening, taking in all, the collection of, every investor's opinion into this messy hole versus the outlook from this very centralized entity of, very smart people with tons of data at their fingertips, but ultimately they are government bureaucrats, and there's, how well can you truly predict the future? And I mean, ultimately it's unpredictable, but I and many other investors tend to bet in favor of the market outlook, which is, would be the yield curve inversion telling us that we're going to have a recession within the next 18 months from that first inversion, which was March 2022. So, yeah, I don't know. We'll have to revise our thinking if that indicator proves wrong, but until it's proven wrong, it's been pretty reliable. And I'm inclined to stick towards that bet of we'll probably see a recession in the next 6
Interesting.
months.
Okay. So now break this down for me, right? Let's say I'm your regular, middle class income earner in the United States. And, I have some money of my money in the market, such as, 401k, or I have a Roth, or I have, other investments on the side, right? What move should I be making to prepare for a recession? Because let's say we're wrong. No recession happens, right? Okay, good. But let's say we're right and a recession happens and, the Dow falls, the market falls, how should I be preparing for this so that I take the minimal amount of hits?
Yeah. Yeah. And it's a great question. And it's what's really on everybody's minds. And, I'm not necessarily the type of person to go around and try to give investing tips for people because, I don't think it's a question of, well, should I buy Tesla or should I buy Bitcoin or should I go all in on bonds, et cetera. Really, a lot of it is, especially investing is just sort of a regular person and you're trying to preserve your financial future and reach certain goals like retirement or saving for a vacation. I mean, the first thing is to ask yourself, what are you trying to protect against? And for most people, if we're talking about a recession, that's having a rainy day fund in case you lose your job. So I would probably tell most people, before you worry about your stock picks or, trying to figure out, what you should be invested in during a recession, make sure you have a rainy day fund. Make sure you have 3 to 6 months of cash set aside. And honestly, if you pick up a money market mutual fund or a high yield savings account, a lot of those rates are above 4%, and in some cases, even above 5%. And you can get a pretty meaningful return, for most of my life. And for many people, really, you've never really been able to earn a return on cash. Maybe you got a 0.1, 0.2% savings rate in your, bank account, and that's nothing. But now at 4 or 5%, that's more meaningful. So I'd say most people should start there. So make sure you have a rainy day fund. Make sure you're contributing to your retirement. Try to. I would probably say for the average person who's not tracking markets super closely, a mix of a couple diversified index funds, try to minimize costs as much as possible, rainy day fund, and really just be diligent about contributing. And really what I tell most people is, don't obsessively trade or check your portfolio every couple weeks or every couple months. Really I say set a plan, be very intentional about it, structure your portfolio, maybe your 401k, and then once a year revisit it. Say, has anything changed? Do I want to have more in stocks? The general thinking is the younger you are, the more you have in stocks. And as you get older, the more you have in bonds. And, we can go into that. But really for me, I'd say most people just have a rainy day fund because what a recession really is a lot of people losing their jobs. And otherwise it's hard to get a recession if everybody's employed, which means everybody's earning their salary, which means everybody's spending. In a very consumer-based economy, you're not going to get a recession without a lot of people losing their jobs. If a lot of people are losing their jobs, then make sure you're setting aside a rainy day fund and make sure you're investing in yourself. Make sure that you have skills that are transferable to other jobs. Nobody necessarily expects to get laid off, but as Warren Buffett always says, who's one of the greatest investors of all time, the best investment you can make is in yourself. So, try to learn as many skills as possible, get certifications, and make yourself valuable. And really, if you do that, the risk of you being laid off or the risk of you not finding a job that can, restore most, if not all of that lost income are hopefully pretty low. And then, like I said, if you pair that with a really good rainy day fund, you're going to be in good shape, and you probably don't need to worry about a recession very much at all.
Okay, now I have a question for you, and to that you make a very good point about having rainy day funds, and I think a lot of people we're in a very high consumer. I think the U.S. economy is a very consumer driven economy, so a lot of people are spenders instead of savers, right? And then they end up getting hit by an emergency or God forbid a recession like 2008, right? 2008 happened.
Mhm.
The mortgage market goes down. You have the real estate market goes down, and then next thing you know, people are like living, having to foreclose on your homes. Now, I want to kind of talk about something a little interesting, right? As far as, and what we're talking about is very interesting, but, March 10, 2023, we get the news that Silicon Valley Bank, right, collapses, right? And then this wasn't really big on it, but March 12th, there was Signature Bank. And then recently, as of last month, this is May 1st, there was First Republic Bank, right? So explain to me about
Mhm.
how because they operate off of the fractional reserve banking, if I'm correct. So
Mhm.
explain to me more as far as, do you believe that there's going to be another bank collapse?
Yeah. Yeah. I mean, it's a good question. If you had said to me, a month ago, will there be another bank collapse? I probably would have said yes. But it does seem like I don't want to say weathered the storm because I feel like that could come back to bite me. But a lot of the worst case fears for the, banking system contagion and, lots of other banks collapsing have seemed to have cooled for the time being. But, really, like as I talked about at the beginning, this is a story about the Fed. And so there are some other reasons those banks failed, but really the structural challenge for them was the fact that the Fed was raising interest rates. And so bonds have an inverse relationship between interest rates and their price, or essentially their value. And so what banks do is they balance out part of their portfolio with they'll own a lot of US government treasury bonds. So the treasury issues bonds to fund its deficits, and then basically big banks, regional banks buy those. And they're known as the risk-free securities in finance. And so a lot of the financial system is sort of pegged to these US treasury bonds. But the reality is that they're risk-free in the terms of credit risk, meaning, the US government is most likely not going to default on you, or at least they're the safest, the lowest risk of default as compared to, basically anybody else out there. But that doesn't mean that they can't lose value. And so, as I was saying, this inverse relationship between interest rates and bond prices, as interest rates rose and the Fed hiked rates, that actually brought down the value of a lot of the bonds on these banks' portfolios. And so, if you can hold those bonds until maturity, which is essentially when you get paid back, you wouldn't have to realize those losses. But if there's all of a sudden kind of a panic and a bank run and everybody, at one time is asking to get their money out, then essentially that forces a lot of these banks who have these portfolios of bonds that had lost a lot of value because the Fed is hiking rates to, instead of holding till maturity, they have to sell them early when they have a paper loss. And so that's how you get these huge holes in these banks' balance sheets. So it can get a little tricky to wrap your head around all the different variables, but really structurally, what it comes down to is the Fed hiking rates really made a lot of banks financially vulnerable. And, in some extent, that's why I also said earlier, this pause that the Fed did in June was a chance for the financial system to catch its breath. And, I really didn't think that the Fed would be able to continue hiking rates since those bank collapses that you mentioned first transpired. I kind of thought that would be the impetus for them to stop hiking, really. But they pushed forward. I think they've done at least two hikes since those first bank collapses. So again, that's something where I've continued to be humbled. I would have probably told you a couple months ago that there's no way they can continue to hike because of these dynamics of banks are already failing, and if you keep pushing rates up higher, that only is going to make more banks insolvent. But they've stepped in with a lot of these sort of emergency lending programs that have provided a lot of support to banks. And like I said, really the challenge for banks is they may have these bond portfolio issues that are hurt by interest rates, but so long as there isn't a run on the bank, they don't have to sell those bonds and incur those losses. And so, if you can restore confidence in the banking system and not everybody's not rushing out to withdraw their money at the same time. You can maybe kick the can down the
Mhm.
road toward a period where the bank's solvency can sort of normalize again. So yeah, it's very much up in the air. To me, it depends a lot on whether the Fed keeps hiking rates and to what extent they do that. Um, I would probably guess that if they do continue hiking rates as much as they've said that they'd like to, which is at least 2 more times, we could very easily see some troubles in the banking system emerge
Got you.
again.
And you know what's interesting, just to talk about that, because I want to talk about the bonds, but I also want to talk about the fact that you know who benefits from all this bank collapses, right? Do you know who benefits?
You tell me. What are
Well,
you thinking of?
Chase Bank. Right,
Mm, yes.
because Chase
Yeah.
comes in, you know, and in a way they're insured because they use most of the taxpayers' money. They come in, they absorb the bank, they absorb the risk, and then the government says, okay, hey, we'll back you up until this point. So Chase, in a way, the bank collapses are helping the bigger banks get bigger, right? Because I'm sure Wells Fargo is just looking at it like, and it's probably like, hey, you know what? Let's get in on what Chase is doing. Next bank collapse, let's put in a bid and let's see if we can get that bank through, right? Now, talk to me a little bit about the. I don't want to get too deep into this, but bonds, right? Why, if the bonds are what return about what 3.8 to 4%, right? That's the average return on a bond, right? Give or take.
Hmm. Yep.
Why keep my money in the banks and get a fraction of a percentage return on a savings or checking account versus just go buy a bond? I do the same thing the banks do.
Mm,
What
yeah. Uh, yeah. It's a good question. I would probably tell people that I guess the way I would think of it is when you buy a bond, and it depends on right. I mean that can mean a lot of different things. There's 3 month bonds that are actually more called bills, and then there's 30-year bonds, and basically there's called a duration risk. And so the longer dated maturity on that bond. So say you buy a 30-year bond, they're vulnerable to these swings in value, right? As we were talking about, basically what these banks saw where they're buying longer dated bonds, because they're trying to maximize the amount of yield that they earn, or the interest rate that they earn. And unfortunately, there's no free lunch in finance, and so if you're earning more interest, that's because you're taking more risk because you're lending money for longer. And so when you go out and you buy some of those longer dated bonds, you know let's say you're doing it for a vacation fund, and you're going to Hawaii next year, and you're saving up $5,000, and you take your $5,000 and you buy 10-year Treasury bonds. Well, the reality is that maybe you're locking in a 4% return, but actually if interest rates fall, or sorry, actually if interest rates rise, then the value of those bonds will go down, which will push the rates up on the bonds you own to basically match the market rate and be competitive. And so structurally, or essentially what happens is the value of your bonds has to go down. So you might have earned a 4% interest rate on the money you invested, but then when you go back to sell those bonds, when you need to pay for your vacation, all of a sudden they may be worth $500 or $1,000 less. And so the advantage of a bank account is you're not taking any of that, what's known as duration risk. And so you could go out and you could buy 3 month Treasury bills, and you essentially take no duration risk. And this is kind of what we're talking about with the inverted yield curve of now. Right now is sort of this exceptional time, or very abnormal period where you can actually earn the highest interest rates on 3 month Treasury bills. So if you could go out and buy 3 month Treasury bills, you essentially have no duration risk, and you're actually going to earn 4 or 5% annualized returns, which would probably be as good or better than most people's bank accounts. So there's right now, it would be actually a pretty good time to do something like that. But in a more normalized market environment, 3 month bills would probably be much lower, and you wouldn't expect to have this inverted yield curve. And there probably wouldn't be as much of a difference between the regular bank account, a regular checking account or savings account, and the rates you might earn there and the rates you might get on, say, a 3 month Treasury bill.
If I'm understanding, it's more about the length of time that my money stays in a bond for the most part.
Yeah, I mean, it's about what type of Treasury bonds you're buying and the risks that you're incurring. And so I guess my point is, normally to get a really good return on a bond portfolio, you'd have to buy longer dated treasury bonds, 20 years, 30 years. But that opens you up to this sort of price volatility duration risk, where that, in a year from now, when you go to cash in those bonds, uh, they could be worth $1,000 less. And, nobody wants to find out that their emergency fund or, vacation fund is, down 10 or 15 or 20%. Whereas if you buy these shorter term treasury bills, you remove a lot of that risk, but in a normal environment, you wouldn't really make much of a return on it. But as you point out, in today's environment with this inverted yield curve, ironically, you'd actually make the most on 3 or 6 month treasury bills. So it's actually, it's actually a very good place to invest right now. And I don't know if it'll stay that way. And that's really a question of what the Federal Reserve ultimately does and whether we get a recession and a lot of stuff like that. But it's certainly not a bad place to be invested at all because you're taking very little price risk, and you're earning a really good rate of return.
Okay. All right. Now, I want to talk more about, you on this side of things as to what made you get into the money markets.
Yeah. Yeah. Well, so it's a great question. I really thought, coming out of college that I wanted to help people as sort of a financial advisor. And that was really my outlook for the world is, if I can share some of my knowledge that I've learned about personal finance and help people structure their finances one-on-one, that will be a very fulfilling life and you can make a good living doing it. And so, I started out and I worked for actually S&P Global, and I worked on their financial markets platform. I felt like that was a good entry point to kind of learn how the financial system works. And then at the same time, I was studying for my CFA, and that stands for Chartered Financial Analyst. And I took the first level, passed that. And, really the hope was to complete all 3 rounds of certifications and then become a financial advisor, helping people manage their money. And then I stumbled upon this opportunity to work for the Investors Podcast Network. And it's a company that I've listened to their shows now I've listened for several years, but I had been a longtime listener at that time too. And I found their job application to actually be a YouTube host, funny enough. And it struck me as just such an incredibly unique opportunity. Somebody in your 20s, you can, basically join this company that almost a dream job of yours that I credited so much of what I've learned about investing and finance to these podcasts. And so I saw it really as an opportunity to, as a financial advisor, you may be helping a few dozen clients, but, if you have a large investing podcast or YouTube channel or newsletter, you may be able to help tens of thousands, hundreds of thousands, or maybe even millions of people, manage their money. So that was really what's, kind of stuck out to me. And I realized that I had a chance to almost bypass a very traditional financial career to maybe do something more in content creation and hopefully reach a larger audience. So I ended up applying for the job. I got turned down initially, but I guess I was persistent, and our company's CEO was willing to meet with me again, and I was able to prove with some sample writing that I knew a lot about finance and investing, and I wrote this sort of ultimate guide to stock investing, which I think he enjoyed. And so ultimately that led to me being brought on as both a YouTube host and newsletter writer. And these days I mostly focus on the newsletter, and that's sort of where I am. It's been focusing on, not only just covering financial markets really well and helping people understand what's going on, but also building a business around a newsletter list. And so that's been sort of my interesting challenge for the last year and a half or so, is trying to figure out how to turn a list of email subscribers really into a sustainable business.
Gotcha. And how is that? How do you turn your newsletter into a sustainable business?
Yeah, so there's really 2 ways for the basic structure of that business model would be is either you have paid subscribers where you probably reach a smaller audience, but you charge people 5, 10, $50 a month for your insights, or you do a free newsletter. So there's a lot of great free newsletters out there, stuff like from the New York Times and Axios, Morning Brew, some real popular ones like that. And they all work under the same model that we do, where you do free paid advertising, or it's a free newsletter, but you have paid advertising. And so, that that is really what supports the business today of, we try to create as much value in the daily newsletter that we send out as possible, which we hope grows our number of subscribers, which then, makes an ad spot more appealing to advertisers because they can reach a bigger audience of folks by buying an ad spot. So that's sort of the general way to think about it. And yeah, I'll pause
Yeah, no,
there.
no, that's pretty good though. No, I like it. Now, where can people, if wanted to, check out the newsletter, subscribe to the newsletter, where can they find that?
Yeah, I appreciate that. They can just go to theinvestorspodcast.com and you should see a pop up for our newsletter. And yeah, it's about a 5-minute read every single day, Monday through Friday. Like I said in the beginning, we cover the 3 biggest stories in financial markets, whether it's yield curve inversion or what it means by when the Fed pauses the rate hiking cycle. Another big thing has been what this AI revolution means for the stock market and Nvidia and Apple, all those sorts of topics. Each day we try to figure out what the 3 biggest ones are for readers to be aware of. And we try to explain it as simply as possible so that, you can go to your day job and, take 5 minutes at lunch or in the evening, read our newsletter. You'll be pretty much caught up to date on the biggest things that are happening. And then you go on with your life. And then on the weekends, we do try to more longer write-ups, and sometimes it's on investing and finance and economics, or sometimes it's on lifestyle stuff or money tips. But it's a slightly different model. We try to have a little more fun with it on the weekend, and or I wouldn't say more fun, but maybe more casual approach of just highlighting things that we're interested in, and financial stories, history, really anything. So yeah.
Interesting. That's good. The link to the newsletter, guys, is going to be in the description. So definitely go check it out. Now, this brings me to my next question, which was a question that I actually wanted to ask was, can ChatGPT tell me what stock to invest in? It's going to give me at least an 8 to 9% yield.
I think a lot of people are trying to figure that out. It's it's an interesting question. I would tell you right now, no. ChatGPT, first of all, is constrained. I think there's like a cutoff where it's not updated with, current data, up until like January of 2021 or something like that. So if you ask it about the stock market, it's going to tell you about what was happening
Well,
in 2021. So it's not necessarily currently
you
updated.
know
Yeah.
that if you are on Microsoft's browser, which I believe is Bing or whatever it is that they come up with, they are actually integrated with ChatGPT or the OpenAI basically to give you live actual data from the web. Now, how does AI affects like the stock market, or as far as the day-to-day trader? How can I use artificial intelligence to predict my next big rise of big stock?
Yeah. I I don't know. I'm not sure I'm qualified to comment on maybe the trading aspect of it, but at least in terms of the economic aspect of it, which I feel like maybe I'm better qualified to comment on. Really the impact I would see longer term on the stock market is, if you think about it, AI is making us hopefully all more productive, right? Automating tasks, for example, you can ask it to, write a sample email for you, or, draw up messages for you instead of, typing things out, quick summarizing content. I mean, it's really great for quick learning and, a lot of sort of administrative tasks, and saving a lot of that time. And so in aggregate, what that means for society, hopefully, is that we're all a little more productive. And if we're all 1-2% more productive, really hopefully what that eventually leads to is greater economic output. You're saving time on sort of BS of writing emails, and then you can allocate that time savings towards, more productive, maybe researching deeply on whatever, the kind of nature of your job, et cetera, et cetera. But really hope on aggregate, what it's going to lead to, in my opinion, is a more productive society, which is able to generate more output. And in terms of output, I'm talking about GDP. And so if you have a growing economy with more GDP, then of course that's going to translate to more opportunities for businesses to boost their profits. And really the ultimate, the strongest driver of financial market returns in the long term is companies' earnings. And that's why you hear financial analysts and investors talk so much about earnings per share, because really that's over time what's going to drive the market returns for the market averages. So my kind of thinking there would be AI is going to make us all more productive. It's going to help boost the economy. I think, I was just reading a paper from Goldman Sachs. I think they estimated that, over the next decade, AI could add an additional $7 trillion of GDP to the global economy. So, we're talking about pretty meaningful increases in global output, which is obviously going to translate to more profits for companies. And, hopefully that drives better returns for stock investors. So that would be more of how I think
Got
of
you.
it.
So now what skill sets or what areas would you recommend people focus on, right? As far as when it comes to artificial intelligence, right? Like, there's the writing aspect of things, there's the image generation, but what areas do you think, because as you said, over the next few years, it's going to add $7 trillion, right? Now, how can I get a cut of that? Because it's not AI making the money, it's somebody leveraging AI, right? So what markets do you think what would you
Yeah.
recommend?
I feel like the most compelling example I've heard of is people using it for software coding. And so, I'm not necessarily a programmer, but I have some friends who are software programmers. And obviously they already get paid pretty well. But, what I've heard from them is, yeah, sometimes I use ChatGPT to check over something that I've already written, ask it if I've made any mistakes, or sometimes, almost like if you have writer's block and you're not sure where to start, you can ask ChatGPT to, to write a baseline of code for you that then you might edit and start working from. So I think really, you're going to see a lot of those big gains for software programmers. And obviously, in such a digital economy, it's hard to imagine specifically what that will yield for all of us. But you can imagine that if we make all of our software engineers a lot more productive, that's going to make society a lot more efficient as we continue to build out, you know, narrower and narrower software systems that are able to help people in whatever niche of the economy they work in. So yeah, I don't know. I mean, I've had friends who are software programmers, and they tell me that you know their ChatGPT has cut back on the amount of time they need to spend working each day by 20 to 50%. So you're talking about a huge productivity gain. And they're actually saying that they need more work to do because they're cranking out their daily work so quickly with ChatGPT. So I don't know, that's pretty anecdotal stuff. I don't know how well that will translate to the broader economy, but you can certainly imagine that at least in that space. I've heard about some use cases in pharmaceuticals. Obviously, there's a lot of disruption coming to the music industry. And then, I mean, even just as a writer, we use ChatGPT. It's not really market ready yet in the sense of, I wouldn't ask ChatGPT to write one of our newsletters because, the wording can be off, and you also don't really know if you have to really fact check everything it says because you don't necessarily know if it's 100% accurate. But it's a great baseline. Like I said, there's no writer's block. I can ask ChatGPT to write 500 words about what it means when the Fed pauses a rate hike, and that might be enough of a baseline where I can feel inspired to go deeper, add to it, edit it, revise it. And I've done that before with some of our writing, actually, of asking it to draw up an outline for a topic for me, and then that saves me 30 minutes or an hour. And then I can actually go more deeply off of that kind of baseline of writing that I might have been able to previously, kind of given certain time
Interesting.
constraints.
And no, you're right about, I like the fact you mentioned, the fact that it cuts off the required hours. What's interesting is, so I'm someone who likes to read, all right? And I go on different articles and different web pages and also get books. But the thing is, it might take you an article of, 3,000 words, might probably take you, depends on your reading, how fast you read. It might take you anywhere from 15, 20 minutes, right? But I found that with ChatGPT, there's like a few extensions out there that allows you to summarize the web page just to the nitty gritty parts of it. And you can just read the summary. So I can consume information. And you're talking about the 50% reduction in, like, it actually increases and boosts your productivity while cutting your time. What's funny is, so in my business, the work I do usually takes about anywhere from 15, 20 hours to complete at a bare minimum. But I've been able to shrink it down to about 45 minutes, right? And then also the
Wow.
staff that I have, the work that they do, I've also been able to, like, which kind of sucks because I had a guy who worked for me, and I was like, you know what, I really enjoyed having him, but I'm like, I could just plug in what he does in ChatGPT, and ChatGPT does it for me in a few words, right? So talk to me. What industries do you think ChatGPT is going to replace, or AI in itself, generative AI?
Yeah. Well, it's funny because so much of the industrial revolution was about replacing, what you might call blue collar work, allowing a lot of people to leave the agricultural industry and move to cities and work sort of white collar jobs. But, I think as you point out, uh, this sort of generative AI is potentially coming for a lot of white collar administrative jobs. And so I don't know. I try not to say that in a fear mongering way. You know, to reference back to that Goldman Sachs paper I was looking at, I think they said, um, you know, like 60% of Americans' jobs will be impacted. And, I might be wrong on the percentage, but, something like that. It was a huge chunk of American workers would be impacted by AI, but they didn't necessarily say displaced because, hopefully this technology is sort of a productivity tool. And, maybe you're spending less time drafting emails or, doing administrative tasks, but, you're not fully being replaced because there's still a lot of things that it can't do yet. And it might allow you to go more deeply on sort of value add knowledge work that an AI maybe can't mimic. And so, I mean, we've talked a lot about that with the newsletter of what does the future of newsletter writing look like, and I mean, it's anyone's guess, or even just the future of news writing in general. And my feeling, which could easily be proven wrong, is that we'll see AI. It'll be really great for quick write ups on breaking news. The Fed just hiked rates. What does that mean? ChatGPT can crank out, an 800-word article instantly. But there'll maybe be a premium on human commentary almost of, you know, i- things that feel very
Yeah.
unique of and let me put it this way. In the newsletter, we've tried to focus a lot on creating our own tone. And so that when people read the newsletter, it feels like they almost get to know us and they're used to our writing style. And I think the more and more we can do that, the more we can differentiate ourselves from sort of maybe a generic AI that can really summarize a news event well, but can't do the personal touch and the creative stuff and making jokes and finding ways to make things relatable to regular readers and sort of really connecting all the dots of what's happening in the world and what are people concerned about, and then making that into a timely, relatable, and sort of interesting piece of writing. So really, I mean, from our perspective, we're trying our best to think about how we can add value as human writers, really. And I think people are going to maybe crave that potentially down the road. Of there'll be so much AI generated content, so many articles written by ChatGPT or the equivalent of ChatGPT in the future. People are really going to want to read something that it goes above and beyond, but is also has that human touch. So it challenges us to be better, and really to try to differentiate ourselves more from other newsletters and also from AI.
Got you. Now this transit, the fact that you mentioned a lot of things as far as maintaining your, for lack of a better word, I'd say the identity where, I can read your newsletter and I can go, oh, wait, Shawn wrote this. Okay. This is how, the investor podcast usually spits out newsletter. But let's talk about the advent, or basically the impact of deepfakes, right? Where, you mentioned the
Mm,
news, right? Let's say now, there's a podcast of, I think there's an AI podcast of Joe Rogan, right? So now
yeah.
let's talk about from a sense of, I could literally right now, if I wanted to make a fully audio, and I'm pretty sure at some point it'll be video podcast of my favorite, of celebrities. You could have literally a podcast where you have, you know, Taylor Swift, and she's not my favorite celebrity, guys. That's not my favorite celebrity, but you could have Taylor Swift and Jay-Z, for instance, having a conversation talking about modern matters. And somebody who's been, living under a rock will not know that, hey, this is not real. So in a way, don't you think deepfake is going to come into a perspective where you're not going to be able to tell what is what?
Yeah. It's, like instinctively, I want to push back on
Absolutely.
that. But I mean, I think there's a lot of practical implications for that. Maybe more, I guess when I think about it, my concerns more go to, the political cycle. You can imagine a world where you get a lot of these AI generated videos around an election cycle, almost smear campaign, fake videos, that actually do a lot of damage and impact people's perceptions of the candidates. And so I see that as a huge, obvious area of, I mean, you could say it's already happening now. I think that will be an issue in this election cycle. But, again, it brings me back to my point of, one, differentiating yourself in sort of real human content, which sounds so funny to say now, but I think in 5 years from now, that point will resonate of really thinking about differentiating content that's literally made by humans or stuff that's made by AI, and also really being able to prove that it was made by a human. And I don't know how we'll do that, but one thing I thought about is whether live content will be more important, or we'll have a bigger audience and maybe it does now, and that would be something like a Twitter Spaces. Like I, you maybe you can't maybe you can generate an image or even simulate a podcast, but when you go on a Twitter Space and it's a live audio and you're hearing people go back and forth on their thoughts, um, almost like going back to the days of when live radio was really popular. In some weird way, we might see this reversion to, well, yeah, I watch simulated movies and stuff created by AI, and in many ways, it might complement sort of existing content that we consume. But then there'll be this premium on, well, yeah, but I really love to go on Twitter Spaces, and I have my favorite people that I listen to on Twitter because I like to know that I'm listening to a real person. So that's sort of where my brain goes. But I mean, it's an incredible time. It feels like we're on a new paradigm of potential. In many ways of what I would imagine it would have felt like in the 90s when the internet was really first booming.
Yeah, but the thing about the internet was obviously there was a bubble that burst, and then once that did, there was a lot of companies that went under. Right, there was a lot of, because back in the the early '80s and '90s was, if you invested in a, which brings me to my next question was, I mean, if you were a .com company and you startup, I mean, you could go to a VC and boom, they'll give you money, right? And now I think we're like in
Yeah.
the same age of the AI startup. Oh wait, I have an AI that can, it's funny. I said this is, if somebody invents an artificial intelligence dating process for, where it's like a guy could have a virtual girlfriend. It's like lifelike. I think that's $1 trillion industry. That's my opinion.
Yeah. Yeah.
But now let me, as we kind of segue in here, and we wrap up, I want to kind of talk about, finding the right company. Let's say a company is going public, right? And let's say like Tesla or, Facebook or Amazon. How do you know a company has the right potential to actually hit and actually give you a high return, especially if you're now, as the public now has access to that investment? What are key things that you look at for when determining an IPO is actually, worth it?
Yeah. It's a great question. And it's something we think about a lot. And the answer to that question in some ways has changed a lot, but also hasn't changed at all in the last few decades. And I guess what I mean there is, it's changed a lot of, you have to consider all the dynamics of, like you said, the .com bubble and these internet stocks. And, maybe you're trying to consider, what the internet means for the global economy and for the stock market, which, seems like a crazy thing to ask now, but it was a huge question in the 90s. And so, really the kind of core essence of what you want to ask yourself is this term called a moat. What is a business's competitive moat, right? Capitalism is absolutely brutal. And so essentially, if you are profitable, that means you're delivering some sort of value to society. And if you can, generate a good living and create excess profits in whatever service or you offer, whatever good you provide, you're going to get new competition who enters that market and ultimately drives down your profit margins. And so the more a company can preserve their profit margins is sort of that competitive moat. What's keeping things away? If you look at, utility companies, they have a regulated moat where essentially, the government doesn't want there to be a dozen, power grid operators throughout the state. They maybe choose one or two energy companies that sort of, operate this regulated market. So in that sense, you have almost this government created and enforced moat where they basically tell one or two companies, you're going to operate the power grid. nobody else, and we'll give you, a regulated rate of return. It's this kind of government created monopoly. And then on the other hand, you have something like Apple, where, there's so many companies that would love I mean, they're a 3 trillion, I think almost or more than a $3 trillion company at this point. I mean, that's an unimaginable number. And it's not necessarily because they're the most innovative company in the world, right? I mean, there are a lot of people who would probably tell you that Samsung is more innovative than them. That's not necessarily their moat. In many ways, it's this brand loyalty and this sort of ecosystem of products that they've created, right? I mean, we wrote about this in the newsletter the other day of, um, I bought an iPod Touch. That was my first Apple device more than a decade ago, and I bought an iPhone and I got an iPad. And then, funny enough, I for years I took photos on my iPad and my iPhone. And then, when they introduced iCloud, all that got updated into iCloud. And then, now, well, of course, all my life's photos are on the iCloud. So I have to keep paying for that. And so I'll just be paying $2.99 a month for the rest of my life. And I'm totally at their will oh, sorry, it's $3.99 a month. Okay, well, yeah. I mean, what am I going to do? They just increased, $3 a month to $4 a month, right? That's a 33% increase. And of course, I'm still going to pay that because I like to easily store all my life's photos that I take on an Apple devices, sort of in this super convenient system that they've created. So, to kind of get back to your question on the IPOs and what to look for, I mean, the first thing really is think about the competitive moat. And that requires you to think a lot about the industry that they operate in, how the companies run. And, 20, 30 years from now, are they still going to have the same sort of profit margins, or are new competitors going to enter the market? And it's a question that, Tesla is uncovering now, right? They're the industry leader in electric vehicles. And they finally achieved a profitability, I think a year or two ago. And, now you see this booming EV market. And the question is, can they sustain the same level of sort of market share and profitability that they've had in the past? And, that gets into a lot of questions about whether they're a tech company or a car company. And, that'll kind of shape how they can protect their moat. But, really, if you invest in a company and they don't have a great moat, probably not going to be a great investment. And then another thing to consider would be, the management of, are these trustworthy, honest people who are trying to be stewards of your money? If you think about it, investing in a business is in many ways the equivalent of, or, if you buy Coca-Cola and you have a fractional ownership share, that's in theory the same thing as investing in a local business in your community. You have an ownership stake in something that, is involved in the real economy. It's not just a number on a screen. It's really easy to say, oh, I bought Apple stock and it's just a number. And is that number going to go up? But in reality, you have an ownership share in a real business that's producing goods and services for people. And, you're entrusting, basically, when you invest in a company, you're entrusting that their management with whatever amount of money you give them. But in many cases, it could be your retirement and your life savings. And you want to really be sure that these people are good stewards of your money. And I mean, there's some different things you can look at to ensure that. But I really, when I think about it, the two things I look at are the company's management. What type of people are they? What's their track record? And then also the moat of, what actual advantage does this company have, and how long can that advantage persist for? And basically, is it going to get obliterated away by new competition? Or is there something like, Coca-Cola, where like they have such strong brand recognition? You could probably say that they'll be around indefinitely, right? There's not necessarily going to be another Coca-Cola. They have such, they're so well known. Everybody, even if somebody made a better soda than Coca-Cola, people are going to still drink Coca-Cola because they know the name, and they have this hugely valuable sort of brand asset on their balance sheet in a way. And that's their competitive
Interesting.
advantage.
No, I like that, man. I like that. Now I want to kind of dive into, let's say I'm a startup company and I'm looking for capital, right? What are key things that I need to make sure that are squared away for me to be able to, I know you're not a VC, but what are a few things that I can square away, make sure I take care of, that's going to make me a high candidate of being invested in by, getting some investments from a VC?
Yeah, I don't know. I mean, that's a good question. And I mean, really, what I'm sort of reminded of is, we had this era where, 2020, 2021, when interest rates were lower, and there's all this stimulus money going around. Um, it felt like anybody it could get money. It didn't mean anything to really get an investment. Anybody, you know, with a half baked idea could go out and get $1 million investment from a VC fund. And we saw that with a lot of, sort of crazy crypto projects, to even things like WeWork, where, the company was just fundamentally unprofitable, but it was such a compelling idea that they're able to generate a ton of excitement and get billions of dollars in investment. So I think it's interesting, we're in an age now where now the Fed has raised interest rates. And really, I mean, you can think of interest rate as sort of a cost of money. So money is more expensive now, which means that you have to fight harder for those investments. And we saw the VC industry dry up in many ways. And that's actually, we didn't talk about it too much, but in many ways, that's kind of was another big factor in what drove the Silicon Valley bank collapse, because they primarily banked these Silicon Valley companies and startups who at one point were, very flush with money, which, boosted the deposits of the bank. But then what that eventually led to, as rates rose and the VC market kind of dried up and those companies spent down their balances, all of a sudden, all the money had flowed out of the bank, and all these VC customers were spending down their money, and the bank was having to meet those withdrawals, and then they're selling their bonds at a loss, which we also talked about earlier. So I guess my point is, I don't think I have a good answer for how to do that, but boy, is it a lot harder now than it was a year or two ago, or I guess more like 2 years ago at this point. And there's actually been very serious economic implications of that. Case in point, Silicon Valley Bank, where it actually triggered, a bank with more than $100 billion in assets to
Yep.
collapse.
So that's interesting, man. No, and I asked the question about VCs because, there's a lot of entrepreneurs that watch this, and a lot of entrepreneurs are, they have this great idea and they're like, oh, you know what? Let me get some capital. I'm more of the mindset of, if your idea does not make money on its own, then injecting someone else's money in there is just going to be a waste of their money. Right. So I'm a big believer of, you need to find a
Yeah.
way to get more money, and then an investor comes in, looks at your portfolio, and it's like, okay, hey, you have this much. Or, you know what? Let's just clean up your books here. You already have a business model that works. So me kind of putting my money in, it's not really high risk, right? But yeah, let's kind of dive into
Yeah.
this questions here as we wrap up. It's basically my list of dumb questions. I've had guests to say, let's call them the fun
Okay.
questions. So it says, so the first question is, does passing the CFA level 1 exam mean you're able to predict lottery numbers?
No, no. Actually, I would say it makes me more keenly aware of um, how skewed the odds are against you in gambling or like a lottery system, to make money. There's, a metric called the expected value, where you multiply the percentage probability of winning versus the payout. And unless there's a positive expected value, then it doesn't necessarily make sense to do that kind of gamble. So no, definitely not able to predict lottery numbers. And also because of kind of that statistical thinking that I very much got exposed to doing the CFA program, um, would be would be painfully aware of how much the odds are stacked against you. But that said, gambling is fun to some extent, right? Like I'm not a gambler, but every Christmas my mom buys us lottery cards, and we do the little scratch off ones for a couple bucks. And I think I've almost never made any money my entire life. Maybe like $2 or $3. I think maybe the most I made was $10. But yeah, those have never been a good
Wow.
payout.
Okay. Okay. Good. So now no lottery predictions there. All right. So the second question, because I know you used to be in a frat, does your your fraternity experience help you picking stocks for investment?
It's also a good question. I don't think there's a clean way to say yes to that, but I had a very positive experience. We weren't the fraternity that I was a part of was very much not the one. There was no
Yeah.
hazing. We weren't crazy partiers or anything. We actually did a lot of volunteer and charitable work, and honestly, it helped me find my way through college, made a great group of friends and sort of a support group that probably pushed me to do better in school, be more involved in the community. And I would say that set me up on the life path that I guess I'm on now. So, directly, no, it it probably doesn't, but indirectly, it's positioned me to probably be a more well-rounded person who's able to um, think through the implications of. I mean, there's a lot of things to consider when you're talking about investing. Um, Everything from interest rates, right? And sort of the macro risks of how that way impacts things. And then also the micro stuff of just like what we're talking about with the moat of whether the company itself is even fundamentally profitable. So there's a lot to really think through. And I think the more well-rounded you can be and the more unique perspectives you can bring to investing, maybe the better off you'll be. I know, for example, um, I interviewed at a private equity fund at one point, and their whole thing was that they like to combine music and investing, which seems maybe really unintuitive. But and I think the founder of the company was a musician, and he could see patterns in music, and then he could relate that to patterns that he saw in economic data and financial data. So, I mean, I'm not a musician. I'm not sure that would have worked for me, but it was really interesting of like the more, your background, even if it's totally unrelated to finance and investing, maybe the more well-rounded you are, you can actually bring things that give you a unique perspective to make better investment decisions.
Awesome, man. Awesome. That's good. Okay, good. I like the fact that your frat was not the crazy type, but which is kind of, everyone has your experience, but it was an absolute pleasure having you on. Any last words for the viewers? Anything you want to say? Um, Anything you like? Any words of it?
Yeah. So my general advice for people is if you are interested in learning more about stock investing, go through and read Warren Buffett's shareholder letters for his company, Berkshire Hathaway. There's these websites that have archives of, going back 50 or 60 years of every annual letter he's ever written. And they're just a masterclass in thinking about business and finance and investing. And you'll hear all about competitive moats and management and some of the stuff that I mentioned there and even more. And so, yeah, if you're really serious about learning about stock investing, why not learn from the best, right? By reading, I don't know, maybe it'd take you a dozen hours to go through and read all those letters, and you'd be smarter than 99.99% of people about finance and investing right from there. And then the other thing is, if you like kind of what we talked about today and felt like I did a good job of outlining, the bigger picture to financial markets, and I'd really encourage you to subscribe to our newsletter. The newsletter is actually called We Study Markets by the Investors Podcast. And so, it's a daily newsletter, 5 minutes to read, and it will help give you the bigger picture of what's going on and what it all means. And I think that's it. And thank you for having me on. It
was great having you on, guys. And definitely go subscribe to the newsletter. The link is going to be in the description. Check it out. And obviously, give a shout out to Shawn. And that's it. Yeah, you guys enjoy.